So thank you guys for joining this webinar where we'll get to learn from Tina about how she achieved her financial independence and soon to be financial freedom as well. But before I get started, I just want to quickly introduce myself and my company. And I know some of you might know already. But first of all, disclaimer, everything mentioned here is for general informational purpose only. Please consult with your financial advisor before taking any investment decisions. But about me, I moved to the US when I was 16 years old, and you see a picture of me and my husband, also my host family, and also my family in China, who I was gonna go see in summer, but I don't think I'm going because it's just so hard getting in and out of the country, into China or out of the China right now, um, with the COVID situation there. Um, by education, I have more of analytics, data, audit, supply chain, a mix of everything. And through my business in Life Mission Capital, which you see in my background and also here, is I've really leveraged my skills in underwriting and also networking as well, to bring investment opportunities for myself and also my investors. My real estate journey really started in 2019, when I was accidentally house hacking. My tenant paid all my insurance and bills and utilities even, and I didn't have to pay anything. So I thought that was nice. So I purchased another duplex from there, and then I invested in 150 units between passive and active investment. I also started a club where I work. And started my company to help others passively invest as well. I love financial literacy for kids or adults, and one of the podcasts I've been on is called Soultastic. If you have kids, I recommend you checking it out. They have a lot of practical tips for parents who want to not just build a legacy, but also pass along the legacy as well. So the reason I decided to invest in real estate syndications, which most of you are familiar with, is because um, this tenants and toilets. I didn't want to deal with that anymore. Just too much risks, and with just you know the cash flow I was getting. So instead, I went into apartment syndications, and those are some of our investments. And typically, our partners have 500 to 1,000 units in their portfolio, and have been doing this uh, full cycle a few times as well. And those are the partners that we have. And we really focus on a data driven approach and having a network of experienced operators that we work with, and also want to develop meaningful relationship with our investors who are our sponsors. Here's my team. David Monroe, he's my mentor, also certified commercial real estate investment member. He's also advisor as well. He has over 200 units through his personal investments and just direct joint venture partnerships as well. And also, he is also a teacher at instructor at the CCIM, teaching market cycles analysis. So I also pass a lot of questions and things to him when it comes to about the market and things like that. And Derek is an underwriting consultant, and we use him on a consulting basis. He has over 13 years of financial experience in acquisition, asset management, disposition for a $36 billion investment group as well. Um, so we have him look at our deals to make sure the numbers tighten and buttons up. So real estate syndication is really, think of us in a plane where the general partners are pilots and you guys are in the passenger seat. We're going to the same destination, financial freedom, which is what we're going to talk about today. We're really using syndication as a method where the passive investors get to leverage what? Leverage the sponsor's time, knowledge, team, financial strength, signing on the loans and different things, market research and skills, and capital of other investors, so we can pool our capital together to invest in a bigger deal together. And the general partners do many things from broker relationships to finding a buyer to performing due diligences. There's just a list. I don't want to read it off to you, but it's a pretty extensive list that we need to do to bring that deal and also execute the business plan. And people mostly invest. I mean, today people invest just for two reasons: diversification and inflation resistant, and also tax benefits as well. I guess those would be top three reasons people invest in real estate syndications. And without that, it's all hands off compared to doing without tenants and toilets. So today where our focus is on financial freedom. And why is that so important? Because why do we want to talk about that in details is because there are different stages, and we put this from um, a source that we trust. But meanwhile, there's a few stages before that. We kind of focused on the 5 and 6 and 7. The step 4 is financial security. I'm assuming all of us is passing the security stage. That's why we're here. Otherwise, it'd be harder to think about investing if you're not even financially secure, right? So we have the financial independence and financial freedom and financial abundance. Just at a high level, independence is where you can cover your minimal expenses, um, and financial freedom is where you can have somewhat a little more luxurious lifestyle, perhaps buying things without concerning so much about your budget, and uh, can take trips here and there. And financial abundance is where um, it's not only the most challenging stage in our opinion, but also the most important one, because this is where you have so much wealth that you're able to give people and what you have and pass it along and help others build their legacy as well. And obviously, you don't have to wait until step 7 to do it, depending on your heritage, your religion, or whatever background you have. You may even do it from step 1. so so wanted to just do a quick plug in that we do have a 506c opportunity available when it comes to talk about building legacy in this stage of economic cycle. It's very important to be diversified. I will have an investment opportunity that's one investment in 3 apartments across 3 states with minimum of 50,000, about doubling your money in 5 years based on projections. So without further ado, I'd like to introduce Tina. So, Tina today is going to talk about how she gained her financial freedom through passive investing. And I'm going to give a quick intro about her. She received a computer engineering degree from University of Arkansas, which is the same school I went to, even though we graduated different years. Her background is in IT, which may resonate with some of you. So about 9 years ago, her company laid her off. Wasn't laying her off, sorry, was laying people off. So thankfully, she's still here. She actually worked for the company for quite a while. So she set out to find ways to find multiple income streams, so she wouldn't have to be in such a um, scarcity mindset about worrying about her bills if she ever were to get laid off. So she did what she knew first, which was buying foreclosure homes, and she also purchased a sixplex from there. um, Obviously, it's a lot of work with another full-time job that she has and kitties that she has. You can see her holding. And then she started diversifying her portfolio through passively investing in real estate syndications, which is an aspect that she's also passionate about. Her portfolio is now fairly diverse, consisting of residential properties, 6 apartment syndications, hotel syndications, ATMs, and a couple of real estate investment trusts. So I wanted to have her talk to you today, just sharing her experience. And I am actually looking forward to learning something new as well, because even though I've met Tina through quite a few different occasions, um, but there's just so much more that I feel like I can learn from her as well. So Tina, we just want this to be kind of a casual style. And guys, if you have any questions, feel free to put it in the chat. So I'm going to ask a few questions that I prepared ahead of time to give Tina a baseline to start with answering. But Tina, before I get started, do you have any other intro to give us, or background like to give us before I start asking you some questions?
No, I think you did a pretty good job of covering all that I want to sort of discuss in my bio.
Okay, awesome. Yeah. Um, so
And
the
sorry about
question.
my cat.
No, you're good. I think the questions I'll have will also give you a background of her as a person as well. So first is, the good thing always too good to relate to is what is the number one reason for investing in real estate, and in another word, why is financial freedom so important to you?
So I real estate investing is a powerful way to be financially free. Why is it so important for me? I think because money plays a major role in every aspect of our lives. We need it for our basic needs, food, shelter, utilities. I grew up fairly poor. I guess you could say it in like even the poverty category, and we didn't really know um, where our next meal was going to come from, and I certainly didn't want to go back there. My most of my life in grade school, I all I wanted was to find a great job and stay with that for 30, 40 years, the American dream part. um, and then that changes throughout as I got the good job and got the money and stuff, and the security, the W-2 job no longer felt secure to me. So I found real estate. And what I found, what's so great about real estate is that if you think about it, we all have 24 hours in the day. Doesn't matter whether you're poor, you're rich, how powerful you have 24 hours in a day. And we cannot have any more and any extra minute out of that 24 hours. So that's our restraint here on earth. So if we are to trade our time for money, and we have to be there, like your W-2 job, you have to show up in order to earn money, and then you're constantly not going to have enough time to do whatever you wanted to do. And so real estate affords you to be able to not spend the time in order to earn the money. I mean, if you have like rentals or something, literally it's creating money while you're asleep. So that's why it's I think it's a very powerful tool for being financially free.
Yeah, and thank you for sharing that. And I know for a lot of people, they want to create the legacy for their family. Which you spoke at the live stream series where I was talking about building a legacy, and you were on that topic too. And
Mm-hmm.
I think for you also being able to provide for your family, people, whether it's your uh, siblings or your parents, and just being able to provide for them, right? Like having not just caring for yourself, but also being for them, if I understood correctly as well.
Yeah, and I mean even be there for them. I don't have kids yet, but if you are parents and you have kids and they have, practices or something, awards or something, you want to be able to attend those that are important to them and important to you. And if you're in a job where that's not possible, and if you're security free because of the real estate investing, then you literally could just change job or just say, I don't need this job because my family is more important to me than being in this job.
Yeah,
So
definitely. And so, congratulations for already reaching financial independence through real estate. It is a very important stage, because from there you're only going to the next step, which is financial freedom. So, maybe tell us, what were the major steps you took to help you get to financial independence? Any major steps that you can think of?
Um, so the first step is you have to be willing to set aside some time to learn about to actually think through on what you want. For instance, you have to know what your basic spending is. That's the first good step. Know your basic spending, know what you can cut or what you cannot cut, and then know what is your goal in the next year or so. And in order for you to do that, you have to consistently put aside some time every day just to go through that. Because when I first started this, it wasn't a good situation. I was in where my company was laying people off once every year, sometimes twice a year, and I didn't get along with my manager at the time. And so I felt like I needed to find a way out in case I was one of the people who get that notice of layoff. So I actually woke up every day from 4 to 5 o'clock, and that first 2, 3, even 4 hours before I actually had to go to work, I actually um, make myself learn about investing, real estate, and everything I could think of. I read any books I could think of. I listened to all the podcasts, knew what my goals were, or at least to start. Now, don't get caught up in the analysis paralysis and never start. Just know, okay, I really need to make extra $500 a month. How do I do that? And just take that first step, because once you take that first step and you see that you're able to succeed, then that would give you the confidence to get to the next step. Because when I first started, that's what I did. I didn't even know how much I would accumulate in the next 5 years. All I knew is this is my little goal right here, and so I stuck with it. And then as I did it, then I found out more things. Then I did that thing, and then I keep learning and keep evolving. And my goals actually changed, and it's not it's I wouldn't say it changed, because financial independence was still my goal, but it expanded to where I shifted from being an active investor to passive investor to even further um, get me back the time that I want.
Mm-hmm.
So
Yeah, no, that makes sense. And also, from a passive investing standpoint, but you started as active investor. What was the what was, sorry, before that question, actually, I was thinking, a lot of people, it's scary for them to take the first step. What was and but I really admire you for taking that step, but also prioritizing, because everyone is so busy, right? Everyone is so busy, but you made a priority, thinking about your why. You made a priority to learn and remember the not to fall into analysis paralysis. So I just want to emphasize that that's important in making any type of investment decisions. It's important to educate yourself, but meanwhile also important to prioritize the learning, because otherwise things will always happen. In order for things to change for you, you have to make some changes as well. So I just want to emphasize that. But you mentioned
thank you.
interestingly how you went from active to passive. Like for me, the reason for me was just a bad tenant experience. That was enough for me. But what was it for you?
So the benefits was definitely there. What it took for me to get there, I started with buying a foreclosure, fix it up, vetted the tenant. I wore many hats, like rehabbers, property manager, try or even real estate agent, sometimes trying to, like, call people up and ask if they want to sell houses and stuff, things like that. And then I bought 6 duplexes, and I negotiated with the sellers. And at around the same time, I was really busy with work, and I almost killed myself, or at least it felt that way. I was literally working like 80 hours a week in between the two things. And then I found out, okay, maybe this is not the way I wanted to do, because the whole thing about financial independent or financially free is that you take control of your time and allow the money to be more passive, so that you have the time to do whatever you want with whomever you want and on whatever you want, right? And I found out that I was just too busy to actually enjoy my time, because I remember I was with my friend, and I was working so hard, and I just got off the pager, and I was with a friend at a mall, and I literally got a call from my tenant saying that her unit got burned down. And I was like, what? And my friend over there was like, what did I just hear? That your unit just got burned down? Like one side of the duplex got burned down. And we're like, what in the world happened? And like the firemen came and did all the police report and all that stuff. Insurance, I had to call my insurance. And here I was like, what is going on? And so after that experience, I actually turned that over to property manager, because I'm like, I can't handle this. I can't be off enjoying my time and get a call about toilets. And literally, like at night, I would get called on toilets, and trying Googling things, how to unplug someone else's toilets. Those will literally happen to me. So that's when around the same time, I learned about apartment syndication, more passive. And when I saw the benefits of where you still get all the benefits of single family homes, more of the active investment. I transition, right? I still have single family home rentals, but for the majority, I transition over to passive, more of the passive, because what I think is there are people out there who are more skilled than I am, and they're working that's their full-time job, is going to find deals, building relationship, and they have multiple teams in place to find the right property. And so I didn't have that time. Now if I don't have a full-time job, and if that's something I want to focus on, sure, I probably make more money doing that. But since I still have a full-time job, I didn't want to split my focus. And so I decide that I'm going to delegate that expertise to someone else. As long as I can build that trust and that relationship with them, then I can trust them to find the right property for me, and that I don't get called in the middle of the night deciding how to unplug someone else's toilet. And so that was the transition for me. And it wasn't a really hard transition. A lot of things happened that got me there. But once I knew about real estate syndication, it's almost like a no-brainer. I mean, I didn't have a lot of control, which was a good thing because I didn't really care about the control. I'm not like a control freak when it comes to investment. But once I knew that was going on, it's like a whole totally new world kind of opened up in my head. And I'm like, why didn't anyone think of this sooner? But I didn't know anything about apartment syndication when I first started it. It wasn't until like 2-3 years later, after I started real estate investing journey, that's when I learned. And it was just learning through um, podcasts and reading books and just reaching out to people to understand more about it.
Yeah. And I'm gonna transition to the next question soon. But just kind of going. I remember one thing you told me about your first step into apartment. I was asking you, was it scary? You talked about control. You didn't mind the control. You're like, oh, it wasn't scary because I was signing $1 million on loan, but here I'm given 50,000. The risk is much smaller. So I
Mm-hmm.
think it's all in all retrospective.
Yep.
It is a limited risk to the amount you're investing. So the next question I have is, because what I love about your experience is you didn't just stay in an apartment. You went into hotel syndications, ATMs. You try to diversify. Like we talked about diversification.
Mm-hmm.
You want to diversify into different asset classes. And I know you have other investments outside real estate as well, which to help with diversification. So what's your best and worst investment as a passive investor? And what was that like? What was your learning experience from that as well?
So the worst one probably is the duplexes one, and it's not because it was a bad investment. It was because it was a huge learning curve for me. I guess you could say it could also view as a best one because I had such a learning curve when I went from single family homes, buying single family homes that was turnkey, suddenly went into duplexes where it was more it was blue collar, and the tenants in there were already there. And at the time, around the time, I was so busy with work that I didn't do the proper due diligence. I trust, so I bought it through my realtor who knew the seller. They were friends, and so I kind of trusted my realtor's relationship with this person. And so I didn't do a full diligence of walking through every single unit and actually review all the lease contracts. Um, and I should have. I was literally by myself doing all of this. And I think it was over my head a little bit, but all around, all I saw at the time was, oh, I'm going to get $2,000 cash flow from just buying this because it was a great deal. It was an absolutely great deal. But I should have done better due diligence. So it was a huge learning curve. And I think that was
Got it.
the reason that I got a call on the unit was burned down. And then there were some weird, odd tenants in there that I
Got
actually
it.
had to learn.
Got it. So
So
that's your active investment, right? Like
that
you're
was that was act
oh, that you consider
that
that it
was
was a
active.
bad experience
That
from
was bad. The
yeah.
best one
How about
is
passive side? How about passive side?
for a worse one.
Best
I
or
don't know.
worst? Yeah.
Well, okay, so the passive side, I haven't gotten a worse one yet. All of them
Oh.
have been doing really, really well, and I think it has to do with the sponsors that I trust, the operators like
Mm-hmm,
yourself or the people I trust because they have really long track records of earning
mm-hmm.
the preferred return and the return for their investors, and it's usually way higher than what they predict. And so the best one I got is actually the storage one, which I invested early at the beginning of 2021. And because of the weird real estate prices that was hiking up, they ended up selling it 6 years earlier than anticipated. And I ended up with 40% return in 2021.
Yeah,
So that was my best one.
that's awesome. Yeah, I think with the real estate prices going up, we've seen that have a growth in many of the deals as well, specifically in some of the larger cities like Phoenix, um,
Mhm.
with Dallas appreciation. But you mentioned about picking sponsors, right? Like we talk,
Mhm.
kind of tying back to the topic. We know our expenses. So the next is to figure out how we can generate enough passive income to meet the expenses to get to financial independence and then later on financial freedom. And picking sponsors, making sure he'll try everything in your power to make sure you're picking the best sponsor possible that you can feel comfortable with. How did
Mhm.
you go about that?
So a lot of them have their own podcasts. And that's how I connect through them is listening to their podcasts. And I usually listen to them at least 6 months and learn their style, learn about their investment a little bit, just the way they talk. And I think I have a pretty good instinct on who to trust a lot of times. And so I usually would reach out to them and just have a talk and have an understanding of who they are. And one of the questions I usually ask them is, what is one investment that you didn't do, you didn't do as well as you thought you did, and what happened? You kind of understand the adversity that they went through, and what the lesson learned they take out of that, because that kind of tells you a lot about them. A lot of times you find out more about the person, not because of the successes that they have done. It's the adversity that they have to go through and how they bounce back from that. And that's how I usually talk to my sponsor, and just understanding who they are and the track record they have and the investor they have. And if usually what you learn is, if they didn't give the investors what they promised, they're not going to stay in that lot for the long time, and they won't have a podcast, because then people would just put a review on their podcast really badly. And if you read the reviews, then you would know that they're not a very good sponsor. So that's how I kind of learn about the sponsor and work with them.
Yeah, I think asking references and looking at those are definitely the key. Yeah. Um, so the next question I have is still going back to diversification. How how did you approach investing in so many different types of assets? Like hotels versus
Okay, so
ATMs.
yeah, so I started out with apartment syndication because that's what I know. I started with real estate because I love real estate, and I think everybody needs a place to live, and there's so many benefits real estate offers. The other investment actually came because the sponsors that I work with on real estate in syndication, they also have the other types. They have the hotels, they have the storage. And so since I've already had relationship with them, I can trust them to make the right choices on the other ones. For instance, the one that, so I had two investment in 2021 that did really well. One of them give me back like 30% return. The other was 40%. And both of them were apartment syndication. One of them actually sent us an email and said, we actually found another fund or syndication, which is hotel syndication, that we can help you to do 1031 exchange into, right? And so that makes sense because I didn't want to pay the taxes, and 1031 exchanges makes sense, and I didn't have to hire an attorney to do all that. They actually did that for all of us, for all the investors, because the sponsors themselves actually put in like 2 millions of their own money toward this hotels. And so since I could trust them and they give me great return, I decided to also trust them with the hotel part, because that wasn't my intention of ever going to a hotel, especially around COVID time, right? But they were saying that even around COVID time, these three hotels that they had in the syndication was doing extremely well. And so if these hotels can survive through COVID times, then it can probably survive through most of other times. And so I decided to go with that because there was a lot of benefits with that. And plus around I've already had, I don't know, half a dozen of apartments syndication already. So having hotels and having other assets sounds like the right thing for me to do, just kind of diversify a little bit. Um, the storage, same thing. I was already working with a different sponsors who was doing really well for me with apartment syndication. So I went into the storage with them. Same for the ATM. It's the same sponsor. The ATM was slightly different than the apartment syndication. It has a huge cash flow benefits, but it didn't have the I guess the equity part benefit. But that's
The
that again,
appreciation. Yeah.
the appreciation. And so that's why I decided to go with ATM because I wanted both. I want the equity part, the appreciation part, and I also want the cash flow because the cash flow is what keep you um, living if you were to lose your job, and then the growth, the appreciation is what's make you wealthy.
Yeah.
So that's why I decide to go. So every time like an investment come into my email, I would analyze it by saying, okay, what do I have in my portfolio right now? What do I want? Do I want more cash flow, or do I don't want my cash flow right now? Because I still have my job that's giving me enough cash to live, right? And so once I got to that financial security stage, I decided that I need to shift a little and make it where part of my portfolio has more appreciation on the upside when they sell it instead of just the cash flow.
Yeah, it's actually interesting. You mentioned that you started with more cash flow deals and then move into appreciation deals.
Mm-hmm. Mm-hmm.
A lot of people, investors I talk to, if they're not looking to retire in the next 5 years, well, 5 years and beyond, they actually prefer the other way. Start with more appreciation opportunities and
Mm-hmm.
then cash flow because appreciation can really build your
Your
wealth.
wealth.
Yeah,
Right.
because
Right.
for example, a lot of the deals in Phoenix market, yeah, they average when it's done well, they average 70% return a year in the past few years, but
Mm-hmm.
cash flow is like peanuts. So
Right.
it's interesting. Just I feel like it just depends on your overall portfolio and the time horizon you're looking at as well.
It depends on what stage you're in and whether you like your job or not like your job. When I started this, it was like, what happened if I were to be fired
Right?
tomorrow?
Yeah.
I don't care at this time to have appreciation asset. I care that I have cash flow asset in order to for me to not
Hmm.
worry about having a job. And so I
Hmm.
started out with whole mindset of cash flow, cash flow, cash flow, until a couple of years after that, when I'm like, okay, I have enough cash flow and I still have my job. How can I get wealthier? And
Yeah.
so that's when I kind of shifted. Now
Mhm.
there's most of the deals, I mean, even 7 or 8% cash flow, you can't be that. Like the stock market, you can't be that. You can't find any other investment that provide that kind of cash flow. And so real estate provide both cash flow and appreciation. And especially when you go into a lot of the sponsor who are looking for apartment and apartment syndication, they always go in with the mindset of adding value, right? They fix it up, they raise the rent a little, and just even raising the rent just just of $50 a month. If you multiply that by 300 units, you have just now forced appreciation that whole apartment complex into like several $1 million worth more. And so there's the forced appreciation right there. So apartment syndication, I mean, we talk about appreciation, but it's usually provide both. I have some that provide 8 to 10% while still giving me a lot of equity on the upside.
Hmm. Yeah, that's good. Yeah, understanding like internal reflections of where you are, who you are, where you want to go. It just really drives how you plan out your finances and everything.
Mm-hmm.
Um, so I have a couple more questions remaining, then we'll open it up for Q&A. So can you tell us a little bit more about your perspective on the current market in terms of, interest rates, cap rates, and how do you think that can affect your financial freedom goals? Right now, you're already passing the financial independence, approaching financial freedom. Um, so looking at the current market, what are your thoughts overall?
Um, so I definitely think on because of the rise in interest, I think the cash flow is going to suffer a little bit. And I have seen that in the deals that come. I've seen it where it was used to be 9-10% return, or even preferred return has become more of like 6 to 8%. I'm not an economist, and so um, uh, what I think is the residential real estate is more affected by the rising interest than the multifamily. Um, it's because a lot of times the multifamily, they are still finding great deals, adding value. So if the rising interest is, let's say, 5% instead of 3%, instead they're gonna ask for the lower price. And usually if they find the deal and the seller want to just sell them off, then they're gonna give them the lower price. So there's a balance in that. And so I multifamily, so far I've seen the cash flow gone down some, but I don't see that it's affecting that much in terms of overall investment. I'm still getting 3 to 6 deals on apartment syndication like every 2 weeks or so. And so they're not going away that I can tell. Um,
Yeah,
in term of how it's affecting my financial independence, I don't see the effects yet that I can tell at this point.
yeah.
Um, Throughout COVID, it seems like all the tenants were still paying. I haven't had really a lot of issues. It's ironic though, because I've actually seen more issues with tenants not paying before COVID than during COVID, because I think the government actually stepped in and helped out quite a bit. So there were a lot of government programs that helped the tenants to pay. And so I
Mhm.
actually hadn't gotten any information from sponsor or my property manager saying that they're not paying rent.
Yeah. Yeah, definitely. With the right sponsor, they should know where they can get rental assistance and things like that. It should help with the payments of the rent. But in general, also to add on to what you said, I know a lot of people are concerned about the market, the cap rate, and in the cap rate, for some of those who are not as familiar with it, can you can basically think of it as like comparable sale price in your neighborhood if you own a single family home. The only thing about commercial real estate is that it's not just depending on cap rate, it depends on how much net operating income this asset can produce. So
Mm-hmm.
both net operating income and cap rate can play a big factor in when you sell the property.
Right.
So, but a lot of people are worried about cap rate, and a lot of the deals, you have a significant portion, usually more than 50% of the returns in a project is on the back end. So when they sell the property, so people are worried about what happens if the cap rate goes up, and then that means the market is not as good as it was before. And but just wanted to remind everyone, there is just so much capital in the market today. Uh, so there's a lot of demand still. People are still like the stock market, alternative stock market is not good. So a lot of people are putting money into real estate. That's driving up prices left and right. So, um, but overall, my approach to multifamily and a lot of those, not every commercial real estate, but because of the two things I mentioned, a lot of capital in the market, um, transactions still happening. In fact, 2021 compared to this year, Q1 this year, we did 20% more transactions in commercial real estate compared to last year. So a lot of capital in the market to do transactions, and also other markets and investments are not doing as good, so more capital coming in as well. So I think it's going to continue to um, kind of keep the market up, even though the interest rates are high. Yeah. Okay. Um, Next question is going back to the financial independence, financial freedom. Um, what were some of your major challenges on your way to financial independence? This could be personal, financial, could be anything. Maybe tell us one or two major challenges.
The first one is you don't know what you don't know. When I first started this, I had the conventional mindset of pay off your debt early, um, put all your money in 401k and Roth IRA. That was the traditional mindset. I knew nothing about real estate. I thought I was financially savvy, and so I actually, when I first bought my home, I paid it off in 3 years. Like literally every month, every single penny I had, I dump it into it. All the bonus I had at Walmart, I dumped into it. And so literally paid it off in 3 years. And just within that 3 years, like just 6 months after that, I learned about real estate. And I'm like, oh, wow, that wasn't smart, because what I did was I was saving what 4%, because it was 4% interest, while I could have keep the money and buying rental properties and earn, 10, 20% cash on cash. And so that's when, once I learned about real estate, I that's what I did. I did the cash out refinance, but not knowing what I knew and not having a mentor, not didn't know anything, didn't know anyone, didn't no one around me knew about real estate. I literally just had to research myself. And the people that around me physically were just the same thing. They had the mindset of just put your money in 401k, and they think that would just, that's the perfect way to get rich when you're retired, or at least have enough when you retire. So I wasn't surrounded myself with, people who are entrepreneurs, real estate investors. I wish I had that opportunity, but I didn't. And so that was, I think, was my first challenge. It just didn't know what I didn't know. If I had someone come and say, hey, look into this, then I would have started when I was in my 20s instead in my 30s. The second thing is, once I got through the active investing and learning all that the hard way, just dealing with tenants and all that, and getting into real estate, apartment syndication, being accredited investor was the challenge. Um, so basically, if accredited investors mean you have to make $200,000 per year for the last 2 years, or have a net worth of $1 million. And around this time, I was nowhere near that. But because now I knew, okay, apartment syndication is where I want to go. So having the rental real estate, this is where the appreciation came from. So I had enough properties that was, with the tenants paying, the equity was building up, plus the market evaluation on them, right? And so the 4 or 5 properties I had suddenly now each have $100,000 to $200,000 worth more than what I purchased for. So those actually helped me to become accredited. I didn't have the cash to be accredited investor, but that's how I was able to transition into the apartment syndication. Um, the third one, I think the third one is going to be my problem a lot. It's having enough capital to put in all the deals that I want. Right. I have like half a dozen deals right now that I really want to be in, but I don't have enough capital to put it in. So
I see. Yeah, I think your laptop is dying.
my laptop is dying, so I have to plug it in.
Yeah,
Go ahead and ask the next
yeah,
question.
but I agree. Having good opportunities, you're actually kind of I would say a spoiled one, because for a lot of people they don't have access to good opportunities. You have access to good opportunities, so that's a good thing. The last question I have, and then I'll open up for Q&A, is what are you doing now to achieve your financial freedom from financial independence?
Um, so I'm always looking for a way to leverage money. And let me explain that a little bit. For instance, I'm always looking around, okay, what do I have in saving account? What do I have in stocks that are just sitting there, not making a lot of money? Who do I know that have money that I can borrow? And I actually have a couple of friends, and they're very risk averse, and there's no way they're going to go into real estate or want to put their money, and they're not learning about real estate, they're not learning about anything other about other investment, and they're at 70 years old, they're not going to do that. And they don't want to put their money in the bank either, because the bank interest currently is what, 0.5% or even 1%, if even that. And so what I did with them is negotiate. You lend me the money, I'll give you at least 3%. And I would take that money and I would put it into real estate, where I'm earning, 10%, 20%, 30%. And so it's a win-win for both. And so that's the other way that I'm learning to leverage money. Um, the second way that I'm doing it is figure out how to make more income. My current W-2 job right now, I'm making good income, but I think I could do better. And I kind of I'm looking for figure out how to, and this is Missy, this is where you inspire me, where you start your own company. And I think that's the best way to build wealth is actually have your own business. And that's been in my mind for the last, couple of years. I just haven't figured out what's that business is going to look like. And so you kind of inspire me that you just start, it feels like you're kind of fearless about it. And for me, I'm very analytical. And so I things have to be perfect in my head in order for me to take steps. And I know that's a weakness because even when I did the real estate investing, I had to figure out, okay, here's my goal. This is what I'm going to do. And I actually had to know what the contingency plan was before I even went off and start buying real estate. And so that's currently my challenge right now is actually figure out how to earn more income. And I'd like to start up kind of like a side business to earn that. So I have more money to play with, to invest with.
Yeah, understand. Definitely. There's multiple ways to grow wealth. Yeah. Um, do something you're good at and you enjoy, whatever that might be, so it doesn't feel like a job. And meanwhile, let your money work for you while you're doing that. So, yeah, I think that's a great way to leverage time and hobbies and things you like. Um, I think that's the what I what I have. So we'll have a question. What is syndication? Um, I'll let you answer. I can go over it too, but since you're the speaker, I'll give the mic to you.
So in the basic term, syndication is kind of like a bunch of people or investors go out and they see this apartment complex that's 300-400 units, and it's, let's say it's $20 million, and they don't have enough money for the $20 million. So what they do is they they're going to be the active investor, they're the sponsor, they're the operators who deal with the active part. And then they go out and find investors to actually put their money toward the deal, and all of them kind of split the profit all together. Usually the sponsor and the operators get more of the profits than the passive investor, and they should, because they're actually put their, they're the one being sued if something were to happen. The passive investor never gets sued. But that's basically what the syndication is. Instead of one person purchasing one single family unit or one single family home, it's a bunch of investors getting together and pull their money together to buy this whole $20 million deal.
Yeah. And the person who asked the question, feel free to reach out to me if you want to talk further on that. Like, I would be considered as a general partner active investor. And I also have ebooks on my website, which, speaking of that, I should share the screen. I think I forgot to, that you can also go download about what real estate syndication is or passive investment is. Um, Oops. Here, lifemissioncapital.com, that you can go see. Um, and also, if you're a little bit more familiar with real estate syndications, there's 110 questions you can ask. Obviously, don't ask all of them at once before you invest in syndications, that you can kind of learn and see what questions would be good to ask on those investments as well. Okay, the next question we have is, what financial tools did you use to invest in your passive deals? Did you cash out any of your retirement accounts, your self-directed IRA, solo 401k, your savings? Maybe list all the potential or possible resources you've used where you can think of.
Pretty much all of them except maybe the solo 401k. I have the company's 401k, which that we can't use. You're kind of stuck with whatever the company has as an option, which I hate because the option is, I think it's kind of crappy. So I put a lot of my 401k stuff with the company in market, money market right now until the market goes down. Then I'll put it in somewhere like more fund. But I have I do have self-directed Roth IRA that I actually use for investing. Um, I use a lot of my savings um, as well. Pretty much, I have enough in the my money market for emergency. Like it's probably even enough for me to live for a year in my money market, and then anything else outside of that, I just put toward passive investing. I have stocks that I'm evaluating right now. As soon as I accumulate enough stocks, and then I'll start selling them at a good price, and then I'll dump that into more passive deals. I don't know if you ever heard of QRP. I think it stands for Qualified Retirement Plan. I have that that I set up, and this is interesting because do you remember when we had the COVID and around September, like between July or September, they came out with the CARE Act, where you could withdraw up to $100,000 per person from your 401k if you had COVID, and I was pretty sure I had COVID. And so I'm like, okay, so that was because 401k is I couldn't do anything with 401k, right? And so I fit with what the e-care the care act, the requirement. And so what I did is I took some of that money out and I put toward the QRP, which allow me to direct that money into real estate. So that
That's good.
help me diversify the risk a little bit, and actually help me earn the money more, because the real estate is now earning me, you know, 10 to 20% a year, while if I had stuck it into the kept it in the 401k, it wouldn't have made that much of a difference. So
Right now would be down. Usually
yeah,
it's
yeah.
six
So
percent per
yeah,
year for the last 40 years.
yeah. So
And
so
yeah,
so Janelle, always look into what money do you have. Like have enough for different uh, tier of emergency fund, but don't let $100,000 just sit there collecting dust, because with the inflation right now, if you just keep that in the bank, you're actually losing money. The other thing that most people don't think of, I don't know if you ever heard of, was it cash value whole life insurance? If you haven't heard of it, go read it up on it. There are a couple podcasts that I can recommend that you can go and listen to, and it talks really well. Start out with the book called Becoming Your Own Banker by Nelson Nash. If you start with the cash value whole life insurance, it's fairly expensive. It's not like term life. It's like almost complete opposite of term life. But if you accumulate enough money in there, you can actually sort of borrow against it and use that to invest as well. And that's right now I have enough in there for my third tier of emergency fund, but it's way more than I want. And so I'm thinking of also borrowing some of it to invest into passive deals.
yes, yeah. Some of my investors use that whole life insurance. Also, I think uh, uh, the you can also borrow against your 401k as well, if they don't allow you to roll over to a self-directed IRA, which most companies don't unless you leave the company. But you can also take a loan against your 401k. um, and the good thing about that is when you pay back interest, it's paying to yourself, the retirement account itself. Yeah, so those are the different ways. um, so the person who asked the question, Janelle, was saying that she's been studying whole life insurance. So that's good. Yeah, it's also an area
Awesome.
that I'm planning on doing this year as well. Um, yeah, I think there's a lot of benefit to it. Not just death benefit, but also the flexibility of investment and emergency while growing tax free. Yeah, awesome. Let's see. I think we had another question about how do you analyze deals.
Great question, Kathy. Okay, so earlier I talked about my goals changing at the beginning. I wanted cash flow, and then after that, I kind of veered toward the appreciation part. So first of all, you need to know what your goals are, and if you need to change it, then change it. You know, it might change every 6 months or every year, or at least kind of turn corner a little bit. I wouldn't say financial independence is still my main goal, but what's in my portfolio has changed. And based on what the goals, then you can figure out what kind of investments support your goals. For instance, do you want cash flow, or do you want new development, or do you want to invest into new business where there's more risk but a lot higher rewards, right? For instance, let's say Missy, she's starting her own business, and that's a lot of risk and a lot of time for her, but it's probably going to be high rewards for her, right? And so if she goes to you, for instance, and she said, hey, I'm starting this new business, would you give me $100,000 to help me start up my business, whatever that is. If you know her well and you know her business plan well, and you decide to invest, there may be risk there, but there may be a huge reward as well. So know what your goals are. If you're talking about just real estate syndication, then you need to understand what markets you want to be in, for instance, or yeah. So for me, what I look at a lot is the apartments, are they in landlord friendly state? Because that's pretty important. You want it to be in business and landlord friendly state. You don't want it to be like state like California, where it could take 2-3 years to actually evict someone, right, while you're still there paying for the mortgage. And so that's the kind of things you want to pay attention to, and I do pay attention to those kind of things. I actually Google, okay, this apartment syndication, where's this apartment located? So my first apartment syndication was actually in Dallas, Texas. And we all know how business friendly Dallas, Texas is, right? And so I started with when I sold my 6 duplexes, I had enough cash. I dumped like $100,000 into the Dallas, Texas apartment complex. Um, what kind of assets do you want? Like, for instance, a lot of the sponsor I know, what they do is what's called value add. They go in and they have this plan to upgrade the apartment a little bit, add $50 rent, things like that. So those are the kind of things that I believe in. Value add will do the force appreciation, which will give you more on the upside while still giving you the decent cash flow. Um, Understand what your risk tolerance is. For example, if your risk tolerance is extremely low, then just keep with the cash flow, because that's what you want monthly or quarterly, to make sure that, if you were to lose your job and things like that. But if your risk tolerance is higher because you have enough money to keep you afloat and you don't need the money now, then put your money toward something that give you higher rewards but higher risk.
Got it.
And the last of all, that's I think is the most important, is know your operator and the track record. Because if it doesn't matter how well the other things are, if you don't have a trusted operator, if you don't trust them, and their track record is crappy and you don't know that, then you go in to lose your money, and it doesn't matter how well the other things are doing. So
Cool. Awesome. Well, thank you. Thank you for going over that. I also sending the link here. Um, some of the resources. One webinar I did on how to vet real estate syndication investments, because in our company, we get sent a lot of opportunities as well, and we strategically only pick very few for our investors. So you can kind of go through how we and our partners select some of the deals. Also on my website, I have that ebook you can also check out as well. I'd like to take this time, as we're getting close to the end of the call, to summarize some of the key things from this conversation today, which I really appreciate. The first thing I think for anyone looking to get to financial freedom is first to understand your goals, what your dreams are, and from a financial standpoint, what would that mean from an expense standpoint as well. So that will also help you understand your risk tolerance in terms of what type of deals, cash flow, more appreciations. Um, and once you get an idea of how one works, you can also shift your strategy a little bit as well. And when you're picking the investments, important to understand the jockey, the sponsors. I think what Tina said about listening to podcasts is great. Attending webinars is great. Just because you don't, it's not just about that investments. It's about the people who's executing it, who's involved, how they deal with their investors, how they react to you. All those are important too. And then in terms of diversification, once you get a hang of things, become familiar in one area, which was apartments for Tina. And then she diversified into other areas once she felt like she had a good portfolio in one area. She diversified into ATM and other areas. Because in terms of passive income, like, no one predicted COVID, no one can predict anything, but it's important to be strategically diversified across all your investments and funding resources, whether it's stocks and real estate, commercial real estate, and ATMs and different things. So I feel that Tina today has given us, a really great bundle of information, has helped educate us, and it's important, and it's up to us for us to prioritize our learnings and take actions, and don't get into analysis paralysis, whatever that next investment opportunity may be for you and your family and your loved ones. So keep your why in the front and center. And use that to help derive the rest of your decision making. So that's kind of my summary for today. Is there anything else you'd like to add, Tina, before we end the recording and the session here today?
Um, no, I want to, well, yeah, I do want to add something. Knowledge is not power. Um, Application of knowledge is power. You can read all the books you want. If if knowledge is power, then all the librarians would be really rich and powerful, right? But it's taking the knowledge and apply it. It's powerful, and sometimes we can have all the goals we want, and if we just kind of learn the a lot of the things that you do in life and to be successful, it's not the technicality part. It's 20% technical and it's 80% mindset. And so don't get into that analysis paralysis. Just take the first action, and then that action will get you to the next step, to the next step, and to the next step.
Yeah, baby step. Take a next baby
Yeah,
step.
yeah.
Yeah, cool. Well, thank you so much, and thank you all so much. I mean, 90% of you stayed on the call until the last minute, so we really appreciate it. Feel free to reach out if you have any questions. If we haven't talked to qualify for most of our investments, we need to schedule a call. So feel free to go to my website, lifemissioncapital.com, and schedule a call with me if we haven't talked before. So thank you again. Hopefully, it was inspiring for you today. Until next time, we do this monthly, so hopefully, see you next third Tuesday of the month. Okay. Thank you,
Thank you
guys.
all. Thank you for your participant.